Hello everyone, my name is Eugene and this is Finance Talk. Today we will speak about another important mistake which modern investors make. And some investors even don't realize that this mistake exists, like dividend traps or not having an investment checklist, which I spoke in my previous video. This mistake can cost you a lot of money. Today we will speak about value traps, how to recognize them, and how you as an investor can avoid them in your current and future investments. Stay tuned. But before we start, I would recommend you to subscribe to this channel for more videos and hit the like button for great confetti. Thank you for doing that. And let's start. Let's understand what the value trap is. I will give you a simple example to understand the logic. Suppose I, as a newbie investor, have $100,000 for my future investments and would like to invest it in the companies which are undervalued by the market. I go to the screener like finviz.com, Yahoo Finance, or any other free or paid one, and type different filters like low PE ratio, low price to book ratio, low price to free cash flow ratio, etc. And then I get the results. There is usually a list of companies which are traded at the lower numbers. And without any analysis, I decided to buy these stocks in my portfolio and see what happens. In some time, I will go back to my portfolio and recheck the numbers. As a result, some of the companies in the portfolio went up in the value, some stayed the same, and some declared the loss. Why did this happen? This is the simple explanation of the value trap. You simply buy assets based on low ratios and other indicators, hoping that the market doesn't understand the true value of the company. It is highly undervalued and the price will go up. Unfortunately, for some companies, this situation doesn't change because in their case, price truly reflects the current situation of the company. Poorly assets, maybe declining in revenues, in the management, maybe some problems with the business model, etc. In some cases, in these lists, you will find the companies which are quite obscure. They are not really famous and their financial position is quite weak. And usually, you would not find any great companies in these lists. Why is that? Let's find out. It is better to look on this situation from the business point of view because I have 10 plus years of experience in running my own businesses and I look at this situation as a business owner. Suppose you have a business which is growing and has a really great competitive advantage. You understand that this is it. I found the gold mine and I need to attract as much capital and as fast as I can in order to grow and get the market share. You go to the investors and receive more debt or maybe issue more stocks in order to scale faster. But in this case, your margins drop significantly. You have high debt to equity ratio, maybe declare some losses in any periods due to high growth. In this case, if you go to the screener and type for particular filters, you wouldn't probably find my company because it doesn't suit all the criteria, even if the business is great. So if you look on this situation from this point of view, you understand that screeners and other business analytical tools do not apply to these companies. You need to analyze them by yourself and find them by yourself. So now let's talk about different value traps and how to recognize them. Usually, these are indicators on which you filter the companies. First, it is the PE ratio. In simple words, this indicator shows how much money you as an investor pay for every dollar the company earns as a net profit. If you would like to know more about this indicator and how to calculate it, I have another video right here so you can understand the concept. So when you go to the screener, you type for example, PE or 1 or 2, and this is quite a visible part. So the market analysts do all the calculations and give you the number. And sometimes companies with these ratios are not great. Another part of it is hidden PE of 1 or 2. This can occur then you project that in 1 or several years, the company make in revenue or net profit the same amount of money you paid for the company today. So you will have the PE ratio of 1 or 2. For example, you buy the company which operates 100 locations around the United States. Currently, it earns $1 million in net earnings. And when you buy the company, you project that in 2 or 3 years, it will increase the number of stores around the United States, and the number will be 200 or 300 store locations. And in this case, the company will increase its net revenues, and you as an investor receive more dividends or more return on your investments. So you will receive the PE of 1 or 2, but this number is not yet implemented in the current calculation of this company. So it is hidden. Next Next indicator with which you should be very careful is price to book ratio, or PB. In simple words, it is an indicator which shows how much money you as an investor pay for the value of the company when it goes bankrupt and be liquidated. Basically, the higher the number, the higher price you pay for assets of the company. But usually when you go to the screener and type 1 or 2 PB ratio, these companies are not great as well. And usually the price really indicates the value of the company because it has very lousy assets. Maybe there is some problem with the management, with the current debt situation, and you need to combine all these factors and analyze this company more deeply. Also, you need to do some calculations about the future price to book ratio and understand how much money would the company assets worth in the future when something bad happens. Next indicator is price to cash flow ratio, which basically shows how much money you as an investor pays for every dollar in free cash flow which the company has. You need to be very careful with this as well, because it is great when the company has free cash flow and this number is increasing, but there are different situations. For example, when the company has a lot of cash on hand, it raised some capital in the past, the business model is great, but now the free cash flow is negative, but the growth perspectives and the market share which this company can acquire is quite huge. And again, if you apply such filters in the screener, you won't probably see this company. Next, let's talk about how to avoid these value traps. I think there are several ways to do that. First of all, you do not need to rely on all indicators. If you look for the company with low PE, for example, 1 or 2, probably it can have higher price to book value or price to free cash flow value. So you need to analyze the whole picture in general. I personally go to lists of 52-week low companies in order to understand which companies lost the most of its price. And this is the great way to start your analysis. Second, if the company has low numbers, you need to dig deep. Why is that? Maybe the price really reflects the true value of the company today, or maybe it hasn't recognized yet. You need to make sure that you really understand the business, you know the management, and you really believe that these guys can scale this business to a new level. Next useful trick which I use is to look for holdings of different investors. If the company you are analyzing meets all of these criteria, I usually go to websites like Dataroma or Guru Focus and find who else from the top investors own this stock. As Manish Pabrai said in one of his latest interviews, there can be thousands of reasons why the investor sold this or that stock, but there is only one reason why he or she bought this stock: to make more money, and he or she projects that the company will earn more. Personally, I rarely go to screeners or different other analytical tools in order to find the lists of such companies. I go to different communities and I watch for top investors, their holdings, and I try to understand their logic of investing. Such communities like Value Investors Club, Guru Focus, SumZero are a great way to start your own research. And then you need to dig deep, analyze about the competitors, about the industry, and about the company in general. That's all for today, guys. I hope you enjoyed the video and it was useful for you. If yes, please leave a like and subscribe to the channel for great videos. If you have any questions or other ideas about future videos, please write down them in the comments below. I will definitely look through and respond to them. Thank you for watching. Bye.